Now that you understand the market dynamics, let's talk about significant price levels in general. Rule number 1, sell at resistance, buy at support. Rule number 2, when a support level breaks, it turns into resistance. So if we get back to this case, we often expect a retest and then the market to go to the downside if the support level breaks. So significant price levels, guys, provide you with this property. We expect the market to bounce back off support, but if it breaks, it turns into resistance, expected to bounce back off resistance. So expected to bounce back off support, but if it breaks, it turns into resistance, expected to bounce back off resistance. And this is a very, very nice example of ES. Let's take a closer look here. So when significant levels are provided to you, like our trigger point, the market is located here. So when the trigger points are delivered to you, the market is located here. This is the delivery time. Now, at this point, this is a resistance level, and we expect the market to bounce back. And this is validation. We see the market struggles to break and bounce back, struggles to break and bounce back. The price action here validates that it's a resistance level as expected. Now, let's take a closer look. Validation. The market attempts to break, but it struggles. Validation, validation, validation. Now, look at the momentum here. It indicates that the sellers give up and the buyers take control. We observe a market shift, and this is the price action. So at this point, I expect the market to push higher. I think it's a support, and now I validated validation, validation, validation. So at this point, this level was validated, and now we understand that it's a significant price level. We expect a significant resistance level to become support after it breaks and validated before. So it broke, support validation, 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 validation. Now there's a long opportunity of support, long opportunity here, and look what the market did after the resistance level, originally resistance, broke, turned into support, providing you with good long opportunity. Guys, significant price levels provide you with a system of expectancy. Now let's explain. I expect the market to bounce back off support. If this does not happen, meaning support breaks, I expect the market to retest. Support turns into resistance, providing you with a good short opportunity. Okay? I expect the market to bounce back. I expect the market to retest if the level broke. With a system of expectancy, it's much easier to understand where the market wants to go. Again, I expect the market to bounce back off support. I expect the market to retest if it breaks. Support turns into resistance, providing you with a good short opportunity. Guys, good significant price levels satisfies this set of rules with a high probability. Otherwise, they are not significant. That's exactly the definition of significant price levels. Not random means significant. This is the opposite. I expect this to happen with a high probability. While random means nothing can be expected and the market can go either direction, coin flipping. So random, coin flipping, the market can go either direction, nothing can really be expected with a high probability. Now, this is a very nice exercise. I will show you a short playback and I will ask you guys to write what direction you think the market is about to move. So this is the crude oil, and my question for you is, could you guess the direction? I mean, to me, it looks just random. So, buy or sell? What do you think, guys? Will the market go to the upside or to the downside? Buy or sell, guys? What do you think? Sell, 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 buy. I don't know, really. It go either direction. Um, the market looks pretty noisy. Buy or sell? What do you think, guys? Buy or sell? To me, it looks completely random. So this is an uptrend basically because the market uh, went up. So buy or sell, guys. Now I'm presenting the trigger point levels, all the previous days levels, what we call the golden levels. And the question that I'm going to ask here is expected. Look carefully at the price action, the reaction of the market to the levels, and ask yourself whether the behavior is more expected or more random. Probably more expected and less random. When it touches the level, it bounces off. When it breaks, it retests, providing you with the opposite side opportunity. So is this expected, guys? What do you think? bounced to the tick. The risk to reward ratio is one of the most important metrics. So you can see what significant price levels usually provide you with a system of expectancy and good risk to reward ratio that you need for taking advantage. Look at this, guys, look at this. Was this expected? Yeah. Beautiful reaction. I like these levels. I totally have no clue how to trade without them. The market just looks so noisy and its behavior is really looks random, is really not expected. But when the levels are presenting on my chart, I get more confidence in my trading. You know how I like to look at the market, at the reaction of the market to the trigger points. So beautiful. So again, significant means not random. I expect this to happen, while random means coin flipping. The market can go either direction. So the EG trigger point is a cloud-based indicator. It produces key levels daily, and these levels are delivered to our customers 10 hours before the market opens. And these levels are fixed and they do not repaint. So how to use it? How to use the trigger point? Before I share my own strategy, guys, let me briefly present our paper titled Beyond Liquidity. It contains many chapters. We tried to explain this algorithm, and when we developed the algorithm, we described the problem formulation as follows. Our algorithm aims at pinpointing exact significant price levels, and these are prices where the behavior of the market is more expected and less random based on several features, based on deep market and historical market data. And this means that when the market respects a level, the drawdown is statistically minimized. That's what the trigger point algorithm attempts to do, to provide you with opportunities while minimizing the risk of volatility and liquidity grabs. So briefly again, our algorithm aims to provide opportunities while minimizing the risk of liquidity grabs. So how to use the trigger points? We know statistically that the market tends to bounce back when it reaches the levels for the first time during the current trading day. This is what we call the first touch rule. But if not, I will show you how I manage the risk more effectively.